Good afternoon to all of our viewers from across the U.S. It is April 17th of 2023. And certainly, we hope that everyone had a great weekend. We're certainly happy to get the week started here. And it's been a very interesting 5 to 6 weeks in the market, right? When we kind of think of what happened last week and the week before, sort of pales in comparison to that negativity and that bearishness and that end of world feeling that many had going into the middle part of March, where the banks were in free fall and there was really a lot of concern around banking liquidity. Now, for those who spoke with us directly, we really sort of made that distinction between the liquidity events and versus solvency issues, which is what happened in 2008. And I think we're slowly over time here seeing a lot of those liquidity issues be resolved. Now, are there going to be some tremors? Probably. And we're going to talk about that today as it relates to the overall market. We really think that 2023 is going to continue to be sort of a stock pickers market, a narrow market, and one where we really do have to pick our spots. So let's go ahead and get started. I'm going to go ahead and share my screen here. And the title of this week's presentation is the US dollar in trouble? Now, I say that a little bit tongue-in-cheek because the US dollar is not in trouble, but from a price perspective, we think it may be. We think that the US dollar may be entering a multi-year bear market. And that impacts how we look at asset allocation. That impacts where we want to put our money within the stock market and the types of assets that we want to invest in. So the three big things that we're going to focus on: narrowing market leadership within the S&P 500 and the NYSE. What does that mean as it relates to S&P 500 direction versus what's happening underneath the hood of the surface? We'll go through that. Number two, US dollar weakness. We think this is a very, very important trend. And then lastly, the signal from commodities versus the headlines around economic weakness. So a few of the headlines that stood out to us: the Fed's talking about a 50% chance of recession. Market is still discounting the future incorrectly. That Veritas saying that there should be more discounting recession. Markets still aren't pricing in recession. Like the news is uniformly bearish and focused on recession versus what the commodities market is actually telling us is a little bit different. So we'll go through that as well. Real quick here, as it relates to the economy, a few key reports that came out this week. First was obviously that inflation continued to come in a little bit below expectations, largely as we're expecting, right? When you look at some of the softening economic data, we expect that to translate into some disinflationary trends. Now, does that mean a return rapidly to 2%? No. And I think you've seen that, right? We had that big fall from 9% to 6%, 5.5%. Ever since then, it's been this very grudgingly slow process of going from 5 to 5.4 to 5.3. And we think that's very emblematic of a more stagflationary type of environment. The other thing that we have seen is jobless claims have started to creep up. Still pretty low, but since we reached that 175, 180 mark or so earlier last month and back in February, we're now closing in on 240,000 in terms of weekly jobless claims. So we want to pay attention to that. Again, a weakening of the growth that we saw in the economy last year. That is something we've been expecting for and designing the portfolio around. So what are the portfolio adjustments that we've been making since last week? Again, very, very small changes, but just adding to the key themes that we like. Increasing that energy and gold exposure. We did send out a promo email in terms of talking about customized gold strategies. I encourage people to take a look at that, reach out to your advisor, reach out to myself if you have any questions on that. Number two, keeping those banks at 0%. We've had a pretty good pop on Friday as it related to some bank earnings, JP Morgan and Citigroup. Again, we're not chasing that space right now. We'll go through why. And then lastly, a rotation from industrials to copper. And a lot of that has to do with industrials have a little bit more stateside sensitivity to economic growth versus copper is more sensitive to the global picture, which includes China and India. And that's a big theme that we're focused on right now. Now, investors remain bearish. So if we look at CFTC net positioning, this is the chart here on the bottom. the amount of net shorts is aggressive, right? And so when we see that net short data that aggressive, there can be this macro picture and backdrop as it relates to the longer term, and maybe that is bearish and maybe not, right? But we also have to be mindful of the shorter term and saying how are investors positioned and where can they be caught offside. And right now, the level of bearishness as it relates to positioning of dollars and cents is very, very short. So we want to be careful shorting the market here, I think. Why? Because everyone's bearish. People have positioned themselves net short the market as a whole, of course. So we want to be careful. That's where the market can push the other way longer than people can stay solvent. So we want to be careful there. Number two, we got to pick our spots, right? This is not a blind rally. This is not an everything rally. This is not a just pile on a ton of risk rally. We need to pick our spots, so we don't want to blindly apply risk. But certainly with everything that's going on, I think it would surprise most people to know that we're at a 1-month high on the S&P 500. And we talked about one thing with the market is we're having a narrowing of market leadership, right? So when we look at the S&P 500 and we look at the NASDAQ, the amount of net 3-month highs in terms of the percentage of issues on the underlying index has been much lower this time around versus where we were back in February, right? So the number of stocks that hit 3-month highs in February is higher than it is today, even though the market is at around the same level. And that just tells us there's a narrowing of leadership, and we have to be much more specific about where we play the market and much more specific of where we avoid the market right now. So this market is not a monolith. So if someone asks you, where do you think the S&P 500 is going? I always defer and say, well, ask me what the specific components of the S&P 500. Here's where I think gold is going. Here's where I think energy is going. Here's where I think technology is going. The S&P 500 as a whole is somewhat misleading here. Gold leadership remains intact, and this has been a big theme that we've been focused on year to date. S&P 500 relative to gold, very unusual. We haven't seen this in probably close to a century where the S&P 500 makes a bottom, but gold is outperforming the S&P 500 off the bottom. That is a very unusual condition. It's a symptom we want to pay attention to, and not just play as it relates to gold, but also how we manage risk and where else we're putting money in the market. Same thing with the triple Qs relative to gold. Triple Qs are the NASDAQ ETF. Again, gold outperforming technology off that bottom there. And so why is gold rising? Right? It's an important question to ask. Why is gold doing this? Why are we at 5,000-year highs? Well, we believe specifically that there are 3 factors driving the price. Number one, that secular peak in the US dollar. We've mentioned this many times, but US dollar is what drives the price of gold because gold is generally throughout history a hedge against the reserve currency in place at the time. So if that reserve currency goes up, not so great for gold. That's currency goes down, really good for gold, right? So we want to understand what is driving the US dollar and where that US dollar could be heading in terms of price direction. Big thing to know, Fed was the first to start hiking in terms of the major central banks. That was a big source of US dollar strength. That is reversing, right? So we believe that the Federal Reserve may be the first major central bank to pause. So in other words, other central banks are continuing to raise, Fed is paused, then the interest rate differentials between the US and other countries is going to narrow, and that should be bearish for the US dollar. Number two, central bank reserve diversification. So if we look at reserves across the Saudi central bank, Russia, China, you're seeing increasingly amounts of other currencies in there as they diversify away from US dollars. And then, of course, geopolitical risk and reckless spending in DC. The geopolitical risk that, again, Saudi Arabia moving away a portion of their petrodollars to Chinese yuan, the partnership they've built with China, that Iranian peace deal that you saw between China, that China brokered between Saudi Arabia and Iran. All these are factors that point to a multipolar world away from that unipolar US-dominated world. And that, generally speaking, could be bearish for the US dollar. And when we get these times of transition, right? So we believe right now the big theme geopolitically is transitioning away from the US unipolar world to a multipolar great power competition between the US, China, Russia, EU, countries of that nature. This is not unusual, right? So if we look at the various reserve currencies throughout history, whether it was the Roman Empire, the Byzantines, the Arabian dinar, or you go to the French franc or the UK pound, they all have certain periods of dominance. But one thing has been consistent throughout history, and that is the utilization of gold and silver as a store of value, going back 5,000 years. That doesn't mean gold's always going to go up. That's not what we're saying. What we're saying is a store of value. It has survived many different empires and regimes. And when you go through these changes, people tend to resort to what's lasted the longest, which has been gold and silver. And we can't underestimate or understate the impact of the US dollar in terms of the price of gold. So we go back into the 70s. This was your big gold bull market, which we did not highlight here. But the gold bear market, of course, was when rates went up under Paul Volcker and we had US dollar go up significantly. Then US dollar sells off. We have a gold bull market in the late 80s, early 90s. Then into the early 90s, we have a prolonged gold bear market as the US dollar goes on a decade-long run. And then that historic gold bull market in the 2000s. Guess what happened? China entered the WTO. We went into recession. We went into deficit spending, the Iraq War. All of those things contributed to US dollar bearishness. And that was for about a 10-year period. And that's when gold really took off. And then over the last 10 years, of course, we had a dollar bull market and a gold bear market. This peak right here, we think, is the beginning of a multi-year bear market for the US dollar. As a result, we think we could be in store for a multi-year bull market for gold. And then, of course, we do remain bullish on energy. The world is dangerously short of oil. When we look at the US oil producers, they're now spending under 40% of cash generated on new drilling. We think that's dangerously short. You combine that with the oil production cut by OPEC, and OPEC now has total market control here as US production has been flatlining. So we really do believe that we're one demand shock away from a significant supply shortfall in oil. And we're playing that through energy stocks in terms of exploration and production companies, as well as the service names stateside. So bottom line, the world continues to shift to this multipolar world. We believe the premium for hard assets may continue to increase. So we do believe investors remain bearish, which may trap the shorts. Number two, we think the market is not a monolith. Leadership continues to narrow, so we need to pick our spots. And of course, the pieces continue to come together for gold and energy. Thank you again. If anyone has any questions whatsoever, please reach out to your advisor. You can reach out to our home office as well. Or outside of that, have a great week, and we'll speak again next week. Talk to you again.